Welcome back, you legends. I'm Dr. Cal, and in today's video I'm going to go through all the key charts that we need to be looking at heading into tomorrow's two risk events, that is Jackson Hole and Nvidia earnings post-market. I'm going to go through a host of money time machine market indicators that you will not find anywhere on YouTube or in the media. So based on the PC, based on the CPC, based on the BPSPX, based on the daily chart, based on the momentum, based on stock market seasonality, what we're looking for is, so let's get right into it, legends. Let's start with the stock market map today. We had a bit of a mixed day today. We had Nvidia and semiconductors in general paring back those gains that they put on last week. And we had Apple beginning to firm up. We had Google, Tesla doing okay. Pretty much all of the tech rally. We had a continuation today at the open. Then we saw some profit taking. If we take a look at all the indices, that's pretty much what we had today. We opened up on all the indices. Then we saw those gains taken back. It was a pretty large gap up. So that actually makes sense. Nasdaq basically flat, S&P slightly down, Russell slightly down, the Dow Jones down by 0.5 percentage point. Let's take a look at the different sectors. Leading today was consumer cyclicals, led obviously, guys, by those gains in Tesla. Let's start with the daily chart for the S&P 500. This is our daily chart, guys. These are all the key levels that we need to be watching on the chart. We have the swing low here at 431, the swing high at 444, the previous high at 460, not quite a previous high, but a gap fill from April of last year. And we're now trading in the pocket between 431 and 444. We have this key trend line down below that connected all the key lows this year and last year. That is the October bottom last year and the March low this year. So what happened today? We opened up, gapped up, and then sold off. Importantly, guys, this is not necessarily bearish. I know this looks like a bearish candle, full-bodied red candle, but notice, we opened up, we basically closed flat, and we closed above the 5-day moving average for 2 days in a row. Yesterday, we closed above it. It is this green moving average. Today, we closed above it again. If you notice, guys, on the volume bar here, today's volume is below yesterday's volume. This is what we call a bullish divergence in volume, or volume bullish divergence, where we get a red day, but the volume is actually lower than the previous green day. There are other examples of bearish volume divergence, and I'll show you one right here. Here it is, red day, higher volume than the previous, green day, significantly higher. This example, we had the opposite. You'll see bearish divergences in volume as the market is declining, with red days coming in at a higher volume tick than green days, until recently when we had that bottom of last Friday. We're not sure yet if this is a medium-term bottom or just a short-term bottom that will end up with a double bottom formation and a gap fill at 431. We're still open to both possibilities. We're just trading what the price action is telling us right now. Right now, guys, volume today was below average. It was a red day, but only slightly, only just, and we still closed above the 5-day moving average. We're still not at a key resistance. A key resistance that I'm watching, guys, is 444, right? Rejection, support broke through. It will now act as rejection. It is also at the point where we have the 50-day moving average, this green moving average. So I'm looking at least a backtest to 444. It may not materialize. We don't know yet. But usually that's what happens when we break the 50. We move down to the 100. The 100 was down here. We held at that 100. We should now see at least a backtest of the 50 and these previous swing highs. So that's what's happening on the daily chart in terms of the price action. In terms of momentum, we're still down. The PPO is below the zero line. We did print 2 pink bars on the PPO. We don't really get a change in trend until the PPO switches back up and we begin to print green bars on the histogram, and we get a bullish cross on the PPO. Not there yet. Still a work in progress. Let's take a look at the RSI. RSI still below 50. Which again tends to lean to selling the rips and not buying the dips. Again, the RSI and the PPO still both of our key momentum indicators indicating that we're still in a downtrend. and that this is still a counter trend rally. The only caveat again is that this counter trend rally has not yet met major resistance. Major resistance is still at 444, potentially slightly lower. I would look at the range between 442.7 and 444 to find a rejection, again, just below the 50-day moving average. Okay, what happens after that? Most likely, guys, what tends to happen when we break the 50, we move down to the 100. The 100 is down here. It is hidden. Let me show you where the 100 is. Here it is. I just added the 100 daily exponential moving average on the chart. So we're looking for something more in line with this, a continuation of this counter trend move into Thursday, a rejection of 444, come back down to fill the gap at 431, tag the 100-day exponential moving average, and potentially form a double bottom there with a positive divergence, slightly lower low and a higher low on the peak. Okay, let's take a look at the Nasdaq. You can take a screenshot of this to record these key levels. We're looking at 370 as resistance. We have this double top back here. It acted as support. Then once we broke through it, it acted as resistance. And so we're looking at 370. We also have the 20-day moving average descending that will act as resistance, and the 50-day moving average. So a lot of key technicals here at 370, and would be looking for something again that looks very similar to the S&P. Tag of 370, reject, move back down, fill the gap on the S&P, tag 352.5 on the triple Qs, and then potentially form a double bottom and begin to move back up. Let's take a look at the VIX very quickly. The VIX still making higher lows and higher highs. It is still in an uptrend. And as long as the VIX is trending up, the market remains in a heightened risk state. So we have to be very cautious. Yes, momentum is slowing down, but the VIX has not yet produced a break. It hasn't yet broken to the downside. Any new uptrend needs the VIX to break to the downside and begin to make lower lows and lower highs. That hasn't happened yet. I'm still looking for something that looks like this. Tag this support line, fill the gap at 444 on the S&P, then shoot back up all the way to 20. Here it is, this prior level of resistance at 20. I expect the market to have formed that double bottom. At that point, I think the VIX will move all the way back down, fill the gap at 14, and then spike again to 25 to form the low for the year on the S&P and the high for the year on volatility between late September, mid-October. And at that point, I think we'll have formed the bottom. Let's talk about the BPSPX. This is the BPSPX. Down here below that is the money time machine buy and sell signal. Up top is the S&P 500. These cycles are my own cycle analysis on the SPX index. They mark major bottoms in the market. The exception was the 2020 to 2021 bull market. We had a swamped bottom here because it was an exceptionally strong uptrend. Then it coincided again with our October bottom. Here it is. And so we're now looking for a bottom to occur between October and early January, late January of next year. So sometime in that 3-month time frame, October, from late October all the way to January of next year. Now, in addition to that, we need to look at the BPSPX. I marked the 38.4 level because it has acted as a key level. Let me show you exactly what I'm talking about. Whenever we break below that level, let me change the color to blue. Whenever we break below it, we get extended weakness. Again, break below, get extended weakness, break below, extended weakness, break below it, get extended weakness, break below it, more weakness, break below it, more weakness. The exception is in a bull market. We had one exception here in that cyclical bull rally that began in March of this year. We had a break below 38 just on the week, but the market actually found a bottom and began to rally. I talked about this in a separate video. More recently, we had a break below 38 and extended weakness. So when do we get a bottom? Well, guys, we get a bottom when we move back up above 38. Here it is, move back above 38. It marked the bottom. Here's another one, move back above 38. It marked the bottom. Let's take a look here. Move back above 38. It marked the bottom perfectly. Again, perfect mark of the bottom. Again, here it marked that bottom, and here it marked the bottom. That's what I'm looking for. I'm looking for this to turn back up and cross above 38.4 to mark a medium-term stock market bottom. We have to talk about the money time machine PC and CPC put to call ratio buy and sell signals. Why? Well, because we're getting very close to a critical level, 1.1 on the PC and 1.1 on the CPC. When we move above it and come back down, that's usually when the market finds a bottom, especially with a bearish cross on the PPO. Here's exhibit A. Boom, it marked the bottom perfectly. It went above 1.1, then came back down. We had a bearish cross on the PPO. It marked the bottom. Another example here, moved above 1.1. We had a bearish cross here. It marked the bottom amazingly well. Exhibit C, here it is, moved above 1.1, came back down. Bearish cross, marked the bottom. Same exact look here. It moved above, came back down. Bearish cross, it marked this bottom, this bottom, this bottom, and this bottom. So we're now expecting it to mark this upcoming bottom. Okay, let's talk about Nvidia and Tesla. Let's start with Nvidia. Let me draw this resistance line out. Now, I don't have any strong conviction on Nvidia earnings, so I'm not actually going to trade the earnings. I think the opportunity will come post earnings, not pre-earnings. And to be honest, I don't see any good risk reward trade to the upside. We do have a lot of downside potential to tag this support line. We tagged it in the October bottom. We tagged it again in that early January bottom. I don't think we'll tag it until October or September, so I don't think that this earnings report will result in that sell-off that we're looking for, at least not immediately. In fact, I'm looking more for something that will fake a lot of people out. I think we'll gap up post earnings, tag this resistance line as we've tagged it before, tag it once again, get rejected, and move down for the rest of the upcoming months to go back all the way to 305 to fill this gap by mid-October. I think that's the most likely scenario. That's just my humble opinion. Do I have high enough conviction to trade it? I really don't. I don't see a good risk reward trade here. I think an attractive setup will present itself after earnings, not before. That's just my opinion. Why do I say that? Well, because it coincides exceptionally well with a few things that we're looking at, the S&P tagging that 444, and the fact that we have seasonality giving us exceptionally good timing hints. And the hint that I want to talk about is this. We tend to get a spike and a top on the 17th trading day of August. These are the trading days, not the dates, the trading days. So the 17th trading day, we tend to get a spike and a top, and then we tend to move back down, form another bottom between the 19th and the 20th. That actually aligns exceptionally well with what the technicals are telling us on the daily chart. Let's take a look at it. August 1st. So the 17th trading day is the 17th bar. That means this Thursday. That means we can expect to tag 444 this Thursday. So that means post earnings on Nvidia. And from there, we can actually expect a move back down to form a low between the 19th and the 20th. So look at that. It matches up perfectly, exceptionally well with the analysis that we already have on hand. So it's just another data point that we can use to see if it lines up with our analysis or not. And it does line up. It does line up with what we're seeing on the daily chart. Now, let's take a look at Tesla. Formed that bottom on Friday and it has been ripping to the upside since. This does not look like a sustainable bottom to me. The move has been too much too quickly, in my opinion. A new uptrend tends to happen more slow and steady. Something that looks more like this, right? More slow and steady. Something that looks like this, right? More slow and steady. Not these very quick rebound moves. These tend to be counter trend moves, not the actual bottom. So what are the key levels that I'm watching on Tesla? We got rejected at the first level of resistance at 240, this prior swing low. Looking at the next level of resistance, this prior support line that is now resistance at 253. So somewhere between 253 and 240, somewhere in the middle here would make sense. So potentially slightly more upside going into Thursday, get rejected somewhere around here and move back down to form a double bottom with a positive divergence and enter our demand zone, this green box of demand at the 200-day moving average around the $200 mark on Tesla. Let's quickly talk about fear and greed. We're still at 47 neutral. If we look at the timeline, it is still trending down. Not yet looking like a bottom, but we're getting close. Market momentum showing greed. We're still potentially going to see some more additional downside before we get that tradable bottom. Stock price strength showing greed. Breadth is weakening, showing fear. Put to call ratio, again, showing fear. We're getting very close to that 1.1 reading that I talked about, guys, where we tend to get market bottoms. Market volatility, VIX still above the 50-day. Nothing good happens when the VIX is above the 50-day, so the VIX needs to break down. It hasn't yet broken down. Safe haven demand still showing fear. Junk bond demand, extreme greed, as big money has continued to buy the high yield bonds throughout this sell-off. So based on the PC, based on the CPC, based on the BPSPX, based on the daily chart, based on the momentum, based on stock market seasonality, what we're looking for is continuation to 444, reject, come back down, fill the gap at 431, and potentially form a double bottom with a positive divergence at this point, rally again into mid-September, somewhere around there, as the VIX comes back down, fills this gap right here at 14, and then shoots back up to 25 in October. If you enjoyed this video, if you found value in this analysis, give that like button a big slap in the face. We would really appreciate it. It's totally free and it helps the channel a whole lot so we can bring you legends more of these videos. If you watched till the end and you did not enjoy the video, I thank you for your time and attention. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.